So do you want to become a millionaire with very little effort? I'll let you on a little secret. You can. So if you put a set amount of money into retirement for a certain amount of time, you become a millionaire. But with all these retirement options, you're probably like, what the? If you're not planning for retirement, you're doing it wrong. So in this video, I'm going to show you what are your options and how. What's up everybody? My name is Nam, and on this channel, we typically talk about personal finance and investing. If you think Social Security is a good retirement plan, think again. Uncle Sam is not going to help us when we cannot work. Social Security is meant to be a supplement, not a definitive retirement plan. If you guys stick to the end, I'm going to dig a little bit deeper on investing with your retirement account. Your odds of becoming a millionaire by investing to your retirement account can be 100%. But what if I die? I don't want to wait till I'm 65 to become a millionaire. First off, you still got a 70% chance of making it till you're 70, which means that your odds are still a lot better rather than waiting to hit the lottery. Come on, man, let's be real. 40 years is a long time. You can do a lot in 40 years. If you don't become a millionaire, at least you have a backup plan to become a millionaire. So learning how to plan for retirement doesn't have to be like mastering a new language. So most retirement plans are very similar and very easy to understand. Some of these depend on how much money you make or how much you can contribute. All right, so let's get into it. The 401k. This is the most popular retirement plan, and you probably heard of it before. Most employers do offer this. The 401k is tax deferred, which means that you actually have more money into your retirement account that allows it to snowball that much quicker. So since it's tax deferred, you pay less taxes now. So for example, if you make $60K a year and you put $5,000 into your 401k, instead of getting taxed on that $60,000, you're only getting taxed on $55,000. And if you're in the 22% tax bracket, this is a savings of about $1,100 a year. But what about the taxes when you retire though? No one really knows what the tax brackets will be like in the future. But in reality, when you retire, you probably need less money than you would now. Most likely if you have kids, they probably have their own lives, their own family, probably have a paid off house. So the amount of money that you actually need in retirement will probably be less than what you need now. So taking less money from your 401k, this means you have less income, which puts you in a lower tax bracket and you have less taxes to pay. So with the 401k, most employers will offer a company match. For example, if your company offers a 5% match and you put in 5% into your retirement, the company will automatically match that 5% that you put in. That's a 100% return. You do this no matter what. It's free money. There's no risk involved. Depending on your company, there may be a vesting period where you can actually get that money that they matched. So for example, if the vesting period is 5 years and you've been just building your retirement account for 3, that company match is not actually yours until you make it past that 5-year mark. So if you leave your company before that 5-year vesting period, that money is not yours no more. You can just take along whatever money that you put into it. So the downside with most retirement accounts is that there are penalties if you withdraw before 59.5. So if you withdraw your money early, you're gonna have to pay taxes on the money that you've taken out and also a 10% penalty fee. So in 2019, you could put up to about $19,000 a year into your 401k. All right, so next we have the 403b. So basically this is the same thing as a 401k, but typically offered to people who work in education or nonprofits. So the biggest difference between this and the 401k is that if you work for a company for longer than 15 years, you can put in an extra $3,000 per year for a total amount of $15,000 in total. So with the 403b, you have the same penalties if you withdraw early, similar to the 401k. Next, let's talk about the 457. This is very similar to the first two, but this is usually offered to state employees or local government employees. One of the good things about the 457 is that if you decide to leave your employer, you can withdraw your money and just only pay taxes on it. You won't get charged with that 10% penalty like you would with the 401k or the 403b. Next, the TSP. This is basically the same thing as the 401k, but usually offered to federal employees and the military. So the TSP is very similar to the 401k. You still get a penalty if you withdraw early, but the main difference is that you can get a company match even though you don't put money into it. Wait, what? Free money? If you have this as an option, make sure you sign up. Man, there's a lot of freaking retirement plans, huh? If I haven't lost you guys yet, make sure you guys hit that like button and to subscribe. All right, let's move on to the next. IRAs. These are individual retirement accounts. So if you work for a company that doesn't offer any type of retirement account, you can open up your own. You can start one yourself by opening an account with Fidelity, Vanguard, Charles Schwab. Even sometimes your personal bank can even offer this. Again, this is a tax deferred account, but with this account, you can put up to $6,000 per year. So typically with IRAs, you have way more control of what you can invest in. This can be a good thing or a bad thing. You can invest into individual stocks, mutual funds, different type of bonds or ETFs. With the ones listed previously, you're more limited to what kind of investments that you can invest in. All right, lastly, we got the Roth IRA. So this is basically the same thing as an IRA, but just has Roth in front of it. The money that goes into this account is after-tax dollars, which means that you already pay taxes on this money that's already going into this account. So this money grows tax-free. So this is really good if you're in a lower tax bracket and expect to make more money in the future. So since you're paying less taxes now, a larger chunk of your income can go into retirement. So when it comes time for you to withdraw your money, it's tax-free. What is in your account is what you get. Another pro is that you can withdraw money without paying a penalty. But there's some rules though. You can use the withdrawal towards a first-time home purchase. You can use the withdrawal to pay off educational expenses. When you become 59 and a half, if you become disabled or passed away. Somebody else would have to withdraw the money since you passed away. Lastly, you could use the withdrawal to pay off any type of health expenses when you're unemployed. So since you know the basic retirement plans that are available to you, now let's dig a little bit deeper on how to actually invest your money for retirement. All right, step one, always say yes to retirement. There are employers out there that gives you an option whether or not to invest for retirement. But the thing is that most people will most likely say no to things that they don't understand. Or they may say they will plan for retirement later. The problem with that is that most people end up forgetting and revisiting the idea of activating their retirement account. All right, number two, make your retirement automatic. Out of sight, out of mind. As humans, we are creatures with many flaws. Whenever something requires discipline, the easiest way to consistently achieve it is to remove ourselves from the equation and eliminate the need for willpower altogether. Next, set a percentage amount that you want to invest. If your company offers a company match, invest up to the company match. Why I recommend a percentage amount is that as you grow into your career and get higher salaries, you don't have to go back into your retirement account to adjust the amount that you want to invest. It just does it automatically. Next, keep it simple. Investing can be as easy as you want or as difficult as you want. For my long-term investments, I like to keep it simple and easy. But I'm gonna share with you 3 levels of difficulty on how to invest. The easiest is to set target date funds. Say you're 25 years old and you plan to retire at 65 in the year 2060. So you would want to find a target date fund that ends in 2060. So typically this type of funds, they invest into different type of assets such as stocks, bonds, real estate, or whatever the fund manager decides to have the best returns. Target date funds will automatically adjust your risk profile as you get older. So when you're younger, you could take on more risks since you have more time to recover from downturns of the market. As you get older and closer to retirement, you want to hold on to as much money as you can. The reason behind this is that when it comes time for you to retire, and if you invested everything into the stock market and the stock market crashes down to 50% of your retirement account is already wiped out. But again, this is all individual preference. Some people are more risky than others. If you want the easiest way to invest for retirement, target date funds is the way to go. So next has moderate difficulty, where you kind of manage your account a little bit more often than you would if you were to do a target date fund, which is kind of like a set it and forget it type of thing. For this level of difficulty, you would want to diversify and allocate your assets. So that basically means that you're not putting all of your eggs all in one basket. This is the method that I typically use for retirement. By diversifying into different assets like real estate or international stock or bonds, this lowers your risk of losing everything. If you Google portfolio allocation, there are numerous strategies to do this. A common method is by allocating your age in bonds and the rest into the stocks. So say you're 25 years old, you would want to buy 25% of your portfolio in bonds and 75% in stocks. I can make a whole separate video about asset allocation and where to place things, but for time's sake, I'll keep it simple. So this type of investment strategy requires a little bit more time on your part and more knowledge. This requires more time because periodically you have to rebalance your portfolio. This could be anywhere from quarterly, every 6 months, or every year. So say your portfolio allocation is 75-25. You want to keep this ratio as close as possible. So say your stocks are doing really well and your allocation now is like at 80-20. You want to sell some of your stock and buy back some of your bonds to keep it at 75-25. This will keep your allocation in balance. The reason why stocks and bonds are so common is usually because they work inversely with each other. When stocks go down, usually bonds go up. When bonds go down, stocks go up. So lastly is the most difficult way, which includes trading individual stocks. So depending on the type of retirement account that you have, you may not be able to do this. Typically IRAs or Roth IRAs, you can buy individual stocks. I say this is the most difficult way of investing since it requires a lot more knowledge and time on your side to actively invest, because this means that you may have to follow what's going on with the economy, keeping up with the news. You may have to learn technical analysis, which you look at charts and different patterns, or companies' fundamentals like like their debt to income ratio or their earning statements. This method requires a lot more work, and you're kind of like an active fund manager yourself, trying to manage your retirement. That's why this is not for everyone's sense of the time commitments and big learning curve that this may require. So since this is the most difficult way of investing, you have a greater chance of higher returns as well. If you would rather passively invest, this is really not the strategy for you. If you take a look at Warren Buffett, one of the legends in the investment world, over his 50-year career and ongoing, he averaged around 21% per year. The S&P 500, which is an index fund, has averaged about 10% per year. That's double. That's a pretty big difference. But again, not everyone is Warren Buffett and they can achieve these type of returns. As you can get higher returns, you can also do very poorly too. If you're not willing to take the time to learn and keep up with your investments, you can actually earn a lot less than if you were just to invest into an index fund. Well, there you have it. Today we talked about 7 different types of retirement plans and a brief overview of how to invest using your retirement. Are you currently investing for your own retirement? If you are, let us know in the comments below. All right, guys, if you guys liked videos like this, make sure you smash that like button, hit that subscribe. Till next time.